Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Chinese stocks pair gains after the government's latest support for the housing market fails to impress. A broader gauge of Asian stocks follows Wall Street higher after rotation from big tech to small caps powered US upside. The TSMC litmus test. Will the maker of chips for Nvidia and Apple add to fears about slumping semiconductor demand or serve up an AI-fueled relief rally? We break TSMC's earnings in half an hour. And the ECB looks to set cuts to rates, expects to cut rates for a third time this cycle as inflation falls below the euro area's target for the first time in 3 years. We are live on the ground in Slovenia, where the ECB will be making that decision. It is a big day for earnings. We have numbers crossing right now from the Swiss company that is Nestlé, of course, with that focus on pet foods, on coffee. Nestlé sees full-year organic revenue increasing 2%. That is below its previous forecast of an increase in 3%. So it's cutting its outlook in terms of the forecasts around revenue. The estimates, by the way, had been just shy of 3%. An increase of 2.8% had been the estimates. It looks now like they expect softer revenue growth. Nestlé also sees full-year underlying trading operation margins at 17%. Margins at 17% on an operational level. That is below the estimates of 17.3%. Nestlé now sees full year 2024 underlying earnings per share broadly flat. A new CEO at the helm after the previous CEO stepped down in August, and no doubt the earnings score will be scrutinised as well. We'll keep an eye on that stock, of course, at the open. Nokia, meanwhile, coming through with numbers for the third quarter. Net sales coming in softer than expected. It's a miss from Nokia in the third quarter with 4.33 billion euros in terms of sales. The estimates had been for just over 4.7 billion. In terms of the adjusted operating margin, that was higher than the estimate. So the operating margin is a beat for Nokia, 10.5%. The estimates have been for 9.45%. We know there's going to be details as well around the important US market in terms of the telecom equipment maker and the demand from some of their telecom operator clients as well. Let's check in on the markets then. Yes, the earnings story is part of the mix. Certainly, you saw the beat coming through again for the banking sector with Morgan Stanley in focus yesterday. The gains, the rallies that came through for that stock on the beat on the earnings from Morgan Stanley, Ted Pick and Co. A gain of more than 6% for Morgan Stanley, and an expectation now across the banking space that bonuses will be juicy this year. Let's check in on European futures then, currently pointing lower by 0.2%. Disappointment once again. We've heard the story before, haven't we, in terms of the officials and statements out of China. The FTSE 100, though, looking to eke out gains of around 12 points so far as we look ahead to the session. S&P futures currently pointing lower by 0.2%. Nasdaq futures off by 53 points. The rotation was pronounced yesterday out of the mega cap tech into the small caps. The Russell 2000 adding gains of more than 1%. And we look, of course, for the data out of the US later today. Let's flip the board. You've got retail sales, you've got industrial production, and you've got jobless claims as well. Let's have a look at the US 10-year, currently yielding you 4.03, just yield movement of 2 basis point yields up in the session. A little bit of pressure coming through in terms of the sell-off on the benchmark. 108 on euro dollar. We watch, of course, the single currency. ECB fully expected, almost fully expected by these markets to cut for the third time. We listen in, of course, to Christine Lagarde at the press conference. Brent 74.48. Iron ore down 3% on the back of that disappointment around officials and a lack of more concrete support for that property market of China. Talking of which, China has announced further support to ensure unfinished homes are completed and delivered to buyers. Let's cross over then to our China correspondent, Min Lo, in Hong Kong, who's been passing the details. Min, 4 trillion yuan program is what's been outlined. What is the expected impact?
Yeah, well, about 2.2 trillion yuan in financing has already been extended to these property developers projects that are included in the whitelist. So they're going to increase this, pretty much double it to 4 trillion yuan by the end of the year. This is below what market analysts have been calling for. Nomura, for example, had been calling for 3 trillion yuan in additional funding. Our Bloomberg intelligence analyst is saying that 11 trillion yuan in funding is needed for this massive amount, 48 million homes that are in the housing market that is not yet completed. That has been a source of small-scale protests in China over the last couple of years. So this is key to shore up home buyers' confidence, because if they are not sure that the homes that they are buying is going to be completed, they're going to continue shying away from the property market. And Bloomberg Intelligence also saying that this 4 trillion yuan credit limit may not actually fully translate into fresh funding because of banks' reluctance to lend. Because if you look at developers' loans from domestic loans so far, it's down 4% despite the establishment of this white list and the credit risk that these banks may be asked to take up, the possibility of more non-performing loans that could kind of diminish the impact of this additional funding.
Yeah, and as you say, banks in China already under pressure, so we'll see how they react to these new initiatives. What other measures have been announced then during this briefing?
Yeah, another key measure is that the government is promising to renovate 1 million homes in these urban villages. Now, these are usually very cramped quarters in urban cities that are usually occupied by migrant workers, for example. And this is quite reminiscent of the shantytown redevelopment program in 2015 to 2018. But the key difference here is that in 2015 to 2018, it was 6 million homes a year on average that was renovated. But the government is promising only 1 million homes to be renovated. And so the scale is much smaller. Bloomberg Intelligence is saying that it could lead to a 15% increase in new home sales if all of those 1 million new homes are sold next year. But she says it is achievable, but it's disappointingly modest. Some of the other measures include subsidies, for example, for families with 2 kids. But I think overall it's disappointing that there wasn't enough measures really targeted at boosting consumption.
OK, that remains a key question, doesn't it? And a source of friction. Still, Bloomberg's China correspondent Min Low with the details on the briefing out of China and some disappointment from some, at least, within these markets. The CSI 300 now down in the session. Min, thank you. To Europe now, and the decision from the European Central Bank expected to cut interest rates by 25 basis points later today, despite policymakers rolling out such a move just 1 month ago. With inflation now below 2% for the first time in 3 years, it appears today's decision just needs a formal sign-off. Our correspondent, of course, covering all of this for us, Lizzy Abrdn, on the ground for us near Ljubljana, where the ECB will be meeting. Lizzy, walk us through what's made the rate cut expectations, the messaging change, and it's been pretty dramatic, hasn't it, since the last meeting?
An absolute about-face, Tom, since we were last in Frankfurt. It's an unusually short period between meetings, and we haven't had a whole lot of economic data in the meantime. So to tell you what they're focusing on, you mentioned the inflation story, back below 2% for the first time since 2021. But on the flip side of that, you've also had these business surveys showing concerns about the growth outlook, particularly in the private sector. Put that together and market expectations really shifted towards a rate cut today, almost fully priced. And what's interesting is that the Governing Council hasn't really done much to bat that away. In fact, most of them have endorsed this. The only member of the Governing Council who's actively, publicly arguing against a cut today is the Slovakian Central Bank Governor, Peter Kazimir, although, of course, there could be more hawks behind the scenes. But that means that now the focus in the press conference will turn to the rate path ahead. And at the moment, the expectation is for faster cuts to a deeper, lower level.
Well, talk us about that projection then, going ahead, beyond this meeting, where, as you say, markets are fully pricing in, almost fully pricing in this 25 basis points. What is the path ahead for the ECB, given inflation at 2%, given the softness in growth? How much tension is there going to be within the FOMC, or I should say ahead of the ECB, of course, not the FOMC, but that's part of the mix as well, where the Fed goes, in terms of the months ahead, the decisions for this ECB as we project into 2025?
Well, it's an interesting contrast, isn't it? The dual mandate of the Federal Reserve and the ECB still having to balance the downside risks to growth and the continued inflationary pressures. In terms of the path ahead, our survey of analysts expects cuts at every meeting all the way to March, and then another couple of cuts in June and December. So that would take the benchmark rate to 2%. Now, you can debate where the neutral rate is, the rate at which interest rates neither stimulate nor restrict the economy. But all of this is based on the data. On the one hand, if you look at the labour market, it is showing signs of easing. Look at the corporate story. Companies like BASF and ThyssenKrupp offloading staff. Volkswagen significantly looking at closing German plants for the first time. And yet, you still have unemployment at a record low. So wages growing at a healthy clip, keeping up that inflationary pressure, but then the ECB having to manage these downside risks to growth. And even just last night, Christine Lagarde flagging the geopolitical tensions in the Middle East, the political tensions around the US elections, so much uncertainty, which means overall, in this press conference today, I am sure Christine Lagarde will continue to emphasise the need for caution and, Tom, again, the need for data dependency.
OK, Bloomberg's Lizzy on the ground for us ahead of that ECB decision, and, of course, will be giving us all the details, the analysis throughout the day, and of course tuning in for that press conference with Christine Lagarde. Do not miss our coverage of that ECB policy decision then. That's at 1:15 p.m. UK time, and President Christine Lagarde's news conference will be half an hour later. Here's what else to be thinking about today. We are expecting earnings from TSMC to drop at 6:30 a.m. UK time or thereabouts. We will bring those to you live and bring you the analysis because, of course, after ASML's fortunes and challenges, particularly around the industrial demand and the autos demand for chips and the equipment that ASML provides to the chip makers, the focus now firmly switching to this foundry giant TSMC, which of course produces those chips for the likes of Nvidia, for the likes of Apple. To what extent will it talk to an AI theme that continues, or will that drag around industrials and autos also impact TSMC? The sales that were released recently were still pretty strong, and the stock is up about 25-26% year to date. We will break that data for you live and give you the context. Meanwhile, 1:15 p.m. UK time, it is, of course, the ECB rate decision. As Lizzy has said, markets almost fully expecting another cut. Third of the cycle, 25 basis points. The press conference, though, arguably will be the more important piece of the story today around the European Central Bank. And at 1:30 p.m, we're going to get data out of the US. US retail sales expected to tick up, in fact, 0.3%, an increase of 0.3% for the most recent month from 0.1%, a touch on the health of the US consumer. We know the cost of financing, of course, is becoming a challenge for many households. We'll break that data for you. And US jobless claims as well, as we know that FOMC officials are increasingly scrutinising the labour market and putting in the weight of their focus there versus inflation. So all of that coming up throughout the day. You can get a roundup of the stories you need to know to get your day going. In today's edition of Daybreak, terminal subscribers can go to DAYB Go on the terminal. The top story right now is the detail coming through from Chinese officials around their additional measures to try and support the real estate market of that country. Investors so far pretty unimpressed. Coming up, US retail sales, as we mentioned, due later today. Is the American consumer holding up? We will bring those for you. And, of course, Wall Street bonuses. US banks and traders, at least within those divisions, are hoping to cash in on the earnings windfall after blowout results. We'll bring you the details. That's coming up. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Happy Thursday, everyone. Now, Morgan Stanley has joined their Wall Street rivals in posting better than expected revenue, unveiling a 32% profit surge for the third quarter. We asked the company's CEO, Ted Pick, about the rebound in deal making and how investors are weighing election risks.
I think you have a number of investors that are actually just sort of continuing to plow forward on the view that the economy is in pretty pretty good shape, and that consumers and corporates are in great shape, so that when there is an election outcome, once there's a sense for whether new policy will actually get affected, then they can have a reaction, and obviously that also then brings into question what monetary policy will look like. I think that our job is just to stay close to clients and to make sure our infrastructure is fit for purpose. So we do run tabletops to make sure that not just that we can help offer solutions to clients, Shanali, but also that we have our act together internally. Even after the election, is there a sense of which party at this juncture is better for the stock market? Do you have a view? No, I don't. I really don't, because I don't know that we can imagine what the combinations will be, what the mandate will be, and what the policy action will actually be coming off of what's been said during the campaigns. What I do know is that the economy continues to be in pretty good shape, and that gives any new administration some tailwinds. But of course, they need to also continue to imagine where we are in the election cycle, and they also have to pay attention to deficits and national debt and all the things you've been talking about. There's the election itself, the vote, and then there's the moment till the vote is certified. Do you expect uncertainty to clear up quickly, or do you think it will last for a while? I know what I'm hoping for is what we all hope for, which is that the election is a certain outcome, and then we just go about getting a sense for what policy is. If there's uncertainty, that could go on for a bit of time, but markets tend to be reasonably sanguine about that kind of uncertainty for a number of days. There could be some jittery behavior, but assuming we know where we're going, the markets should align in due course. Another uncertainty is capital rules around the big banks. The U.S. is mulling revised capital rules with lower capital requirements than initially put forward. How do you feel about the direction of travel? I feel like the direction of travel has been constructive. We are carrying a capital buffer, as you know, about 160 basis points. We continue to carry that kind of buffer because it's an uncertainty that affects Morgan Stanley. And, if I think about the three pillars of things that I care about, Shanali, at this place, I care about a strategy, which is to raise, manage, and allocate capital for individuals and institutions. I care about our culture, which is one of rigor and humility and partnership. And I care about financial strength, capital, liquidity. So whatever the we'll call it vicissitudes of the discussion going into the election, I think it's probably the case that we're not going to have resolution on this until after the election. But I think the industry has made its case on where some real modifications should be made, and I think the regulator is largely listening, and we'll have to see how that plays out coming out of the election.
OK, Morgan Stanley CEO Ted Pick speaking with our colleague Shanali Basak. The stock was up 6.5% by the end of the session yesterday in earnings beat, and talking about the relative strength of the US economy as well. Now, some other stories making the news. Traders at US banks hoping to cash in on the earnings windfall after those blowout results. JP Morgan boosting costs tied to pay by 9% in its commercial and investment banking division in the first 9 months of the year. Goldman Sachs' firm-wide compensation, meanwhile, the expense rose by the same amount, while Morgan Stanley, you just heard from the CEO there, lifted the figure for its Wall Street unit by 4%, so 9% and 4% for Morgan Stanley and its Wall Street unit. The biggest banks are on track to post their best trading year since the onset of the Dodd-Frank era, so it could be a good year in terms of those bonuses. Now, retail sales likely grew moderately in September as consumers in the US contend with high financing costs and elevated uncertainty ahead of that presidential election that Shanali was talking to Ted Pick about. Let's bring in Bloomberg's Valerie Teitel right now. Valerie, we were listening in to Ted Pick talking about the relative strength of that US economy. Is that expected to be reiterated today with the data on jobless claims, industrial production, and, of course, those retail sales?
It's been a bit light on the data calendar for the U.S. This week, but the big one is retail sales for exactly that reason, Tom. Retail sales does give us a glimpse into the third quarter GDP, mostly because of this control group segment of retail sales. That is a direct feeder into GDP, so the markets are going to have their eyes on that today. It's expected to come in the same as prior month at 0.3 month on month for that control group. Have your eye on that. But it's going to give us a better reflection of where third quarter GDP for the U.S. is heading. And I want to show you in my next chart the Atlanta Fed's GDP now, which is a real-time indicator for where the GDP is tracking for the third quarter. It has crept higher in the last few weeks. We're now sitting at 3.2% for real GDP for the U.S. For the third quarter. That is a big number. That is the U.S. Growing above trend. So we'll get hints of that more today in that retail sales figure. Keep your eye out for that. We also get the jobless claims figures today. Now, they expected to be a bit muddied by the hurricane impact. I just want to show you, Tom, in my next chart, just how much those initial claims, were muddied by the last two hurricanes. You see Hurricane Irma and Hurricane Ian had a big effect on claims in Florida. So this print today is likely going to be a bit muddied by that. So we'll have to read through the lines, maybe strip out those states that did have some hurricane impact to get a good guide on where the labor market is going from here.
OK, Bloomberg's Valerie Teitel, thank you very much indeed with a great preview of the data we are expecting out of the US and what it's going to tell us about the health of the consumer and the broader economy. Valerie, thank you. Later, coming up, we're going to break this for you. Chip-making giant TSMC releasing earnings in just a few minutes' time, we hope, as concerns rise about slowing demand in the chips sector. The concerns, of course, from the red bells being run by ASML. Will a similar story ripple through to TSMC, or will it come through with some numbers that maybe give some relief? We will bring you the data when they cross. Stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now to some other stories making the news this Thursday. Israel's military expanded strikes on Lebanon, saying it killed a senior Hezbollah commander. Lebanese authorities say a separate Israeli strike killed 16 people, including a local mayor. Israeli warplanes also struck Beirut for the first time in almost a week. That's just hours after Lebanon's prime minister said the US had assured him attacks on the capital would ease. Here in the UK, Chancellor Rachel Reeves has been urged to ignore the doubters and press ahead with plans to raise £15 billion from Britain's wealthiest. The Institute for Public Policy Research and the Centre for the Analysis of Taxation feel that raising capital gains and inheritance taxes could raise substantial funds for public coffers. Reeves is set to announce the UK budget on October the 30th. Back to the earnings story right now and the details around Nestlé. The top line coming through in terms of a cut to the forward guidance for this maker of pet foods and, of course, Nestlé coffee, I should say. Some board changes as well also being announced by Nestlé. So the board structure is being adjusted. But again, the top line is the cut to the full year guidance. And this now is expected in terms of organic sales. Nestlé expects to see an increase of 2% in 2024. They had previously seen an increase in terms of organic sales of 3%. So they've cut that expectation from 3% to 2%. There's a new CEO at the helm after Mark Schneider was ousted, or at least stepped away from that role as CEO back in August. Laurent Fries is now the CEO, and the challenges clearly are there again for the maker of nutrition products, Nestlé Cafe and pet food. The stock, as you can see, year to date, in fact, is down for Nestlé, a little over 10%. We'll watch that stock at the open, 8 a.m. UK time. Coming up, chip-making giant TSMC releases its earnings in just a few minutes as concerns, of course, rise about slowing demand across the chip sector. But you do, of course, have to distinguish between the demand for industrial chips and autos chips versus those that go into the data centers that underpin these large language models. There are details coming through from TSMC we expect in the next few minutes. Stay with us. This is Bloomberg. Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda. Chinese stocks pair gains after the government's latest support for the housing market fails to impress. A broader gauge of Asian stocks follows Wall Street higher after rotation from big tech to small caps powered US upside. The ECB looks set to cut rates for a third time this cycle as inflation falls below the euro area's target for the first time in 3 years. We will be live on the ground in Slovenia where that decision is taking place. And the TSMC litmus test, will the maker of chips for Nvidia and Apple add to fears about slumping semiconductor demand or serve up AI-fueled relief? TSMC earnings are due just in the next few seconds. In fact, they are crossing right now. Before we get to them, Pernod Ricard, just very briefly, it's a miss for Pernod Ricard in terms of first quarter organic sales, a contraction of 6%. The estimates had been for a contraction of 5%. The Americas part of the business contracted as well, less bad than the estimates, but the pressure really coming through from the Asian part of the market when it comes to this maker of brandy. And we're thinking, of course, about the impact of Chinese tariffs on French brandy. First quarter sales coming in below estimates for Pernod Ricard at $2.7 billion US dollars. The estimates had been for a little over 2.8. To TSMC now, arguably a more important earnings story to think about when it comes to the broader story around tech and around semiconductors. And the top line, the redhead for TSMC, is third quarter net income coming in as a solid beat for the third quarter for TSMC. 325 billion Taiwanese dollars. The estimates had been for below 300 billion Taiwanese dollars. The estimates have been for 299 billion. They've come in above that by around 25 billion Taiwanese dollars. Again, 325 billion Taiwanese dollars in terms of net income for the third quarter. The gross margin also beating for TSMC. The gross margin at 57.8%. The estimates had been for just below 55%. So on the earnings, net income, it's a beat, and in terms of the margin, it's a beat as well for this key foundry, of course, making chips for the likes of Nvidia and Apple, and a gauge in terms of that AI demand. We'll watch for the details on that. Let's bring in right now our tech reporter standing by for some context, Annabelle Drulers. Annabelle, what stands out to you from these numbers?
I think it's that margin, Tom. It's incredibly high. You think about where analysts had seen this going into the numbers, and you were looking at a range here of between 53.5 to 55.5. So at 57.8, you've beat even the highest of estimates by quite a wide margin. And you think about where TSMC sees their longer term target, that's at 53%. So again, it's another signal that TSMC is really robust in that higher end, more advanced technology space, AI chips. That's where it's really dominating the market here, and that's what's really standing out so far. Again, you could have expected, of course, really strong net income figures. We already had that outperformance coming through over those monthly sales figures. But again, just to reiterate, that gross margin, 57.8, it's impressively high.
Yeah, it is indeed, isn't it? And the stock is up 78% year to date. There will be maybe further upside today on the back of these results. And it's a reminder, Annabelle, as you well know, that we have to think about this chip sector and distinguish between that demand, as you say, for those AI accelerators, the GPUs produced by of Nvidia, and that slumping demand for the chips that kind of go into electric vehicles. There's some view as well that maybe the fortunes or the misfortunes of ASML is not necessarily a bad thing for TSMC. TSMC are not having to spend on those EUVs maybe at the rate that they would have, and they're able to use the EUVs, the DUVs they already have, the lithography machines, to produce chips of greater efficiency. Talk to us about what you're going to be listening for on the earnings call and how to think about some of these factors.
Yeah, so there's a couple of different things we want to listen out for. So it's kicking off in about 25 minutes from now at the top of the hour. The first is what they signal around 2-nanometer production. This is their next generation of chips, and we're expecting those to start being made toward the end of next year, perhaps. We'll watch for any sort of guidance around that. Adjacent to it is advanced packaging technology, and I won't get too much into the details of it here, but suffice to say, advanced packaging technology is taking on an even greater prominence than semiconductor production because it integrates multiple components into compact designs, and that's really critical. TSMC has a proprietary technology called CoWoS, chip on wafer on substrate, and what they signal around the expansion of these facilities will be another really critical thing to watch out for. Guidance, of course, really important. Are they going to lift the guidance for 2024? What will they also say about 2025? Power price hikes, another really critical area because Taiwan is pushing through higher power prices for its industrial giants. Our Bloomberg intelligence team is saying that could start to eat into margins into next year. And lastly, just anything they signal around geopolitical concerns, because, of course, we're just a few weeks out from the US election. Taiwan, or TSMC, is pushing through with making production facilities in the US, Germany and Japan. They do need to start to move some of their technology outside of the island. But what they say there, of course, will be another thing to watch out for.
OK, chip on wafer on substrate. I love that you got that in, Annabelle. Annabelle Trulis, thank you very much indeed. Breaking down the earnings coming through from TSMC with that live reaction. And, of course, Annabelle will be listening to that earnings call as well and covering this throughout the day. And we'll be giving you that context on TSMC. With that earnings beat, let's get to the markets then, because earnings is part of the story, certainly, and a key driver. The momentum, the mood seems to have shifted slightly more positive now. And maybe TSMC is part of the mix there. The Asian session right now, the MSCI Asia Pacific is up 0.2%. European futures pointing higher by just 0.1%. FTSE 100 looking to add 24 points. S&P futures are pointing lower by 0.1%. Nasdaq futures down by around 16 points. You did set that rotation yesterday out of the mega cap, the Mag 7, into some of the smaller caps. The Russell 2000 had a very decent session, a very solid session indeed yesterday, ending up around 1.6%. Let's flip the board and look across our set. The focus on the euro leading up to that decision from the ECB, with markets expecting another cut in this cycle from the European Central Bank. 108 currently on the single currency. Could be a bit more volatile around the press conference of Christine Lagarde. Brent trading up 0.4% at $74 a barrel. And iron ore under pressure after more disappointment from Chinese officials in terms of their support measures for that economy, particularly the real estate market. Currently iron ore down 2.6%. So miners and basic resources, that as a sector, could be under a bit of pressure in the session today. The US 10-year benchmark yielding 4.03, yields up 2 basis points. Now, as we mentioned earlier, it's a big day, of course, for the European Central Bank. Expected, as I mentioned, to cut interest rates when they meet later. Our reporter, Lizzy joins us once again from near Ljubljana, where the ECB will be meeting today. A rate cut is being priced in, Lizzy. How much anticipation, then, is there for this decision?
Well, Tom, 5 weeks is a long time in central banking. You mentioned that inflation is back below the ECB's 2% target, but arguably more importantly, even though we haven't had a lot of data since the last meeting, are these private surveys pointing to weakness when it comes to growth, particularly in the private sector. So that's why markets have come to expect a rate cut today. Interestingly, the Governing Council mostly either directly or indirectly have endorsed that. And it means that the focus turns to the path ahead. Now, the expectation in markets is for a cut again in December. And if you look at our Bloomberg survey, most analysts reckon you'll get follow-up cuts, back-to-back cuts, all the way to March, followed by cuts in June and December 2025, taking the key rate to 2%. Now, you can debate where the neutral rate lies. Indeed, there is a debate on the Governing Council where the rate is that neither stimulates nor restricts the Eurozone economy. But what we'll really be listening for from Christine Lagarde at this press conference is whether meeting by meeting cuts are on the table and what's holding that back. And it looks like the answer will be they want certainty on the labour market and they want certainty that inflation is indeed defeated. Because since the last meeting, arguably, this is an even more uncertain geopolitical climate.
Bloomberg's Lizzy Burden, thank you very much indeed for the update and the preview of that ECB decision. And, of course, do not miss our coverage, continuing, of course, throughout the day of that ECB policy decision. It's going to cross, of course, that decision is going to be made at 1:15 p.m. UK time. President Christine Lagarde's news conference will follow half an hour later. Lizzy's on the ground to bring us the analysis throughout the day. Now, the leaders of the European Union and 6 Gulf nations have been meeting against a backdrop, of course, of turmoil in the Middle East. The summit in Brussels, which lasted just a few hours, covered visas and trade, as well as the escalating regional conflict. Let's bring in Bloomberg's Oliver Crook, who joins us from Brussels. Oliver, what was the outcome of the meeting? Was it a talking shop, or were there real concrete details on this?
Yeah, Tom, I think it was a little bit more of talking shop, but we should put it in the context of the fact that this is the first time that the GCC level and the EU level have ever met in their sort of history of that sort of cooperation agreement. There have been discussions since the early 90s of a potential free trade agreement between these two zones. They have never really been able to come together. But what I think is interesting, Tom, is first of all, you did have a single joint statement where they did both, the EU and the GCC, call for a ceasefire in both Gaza and Lebanon. This is sort of a little bit of common ground that they have. There are other issues that they have common ground on. Obviously, there's a new reality here in Europe when it comes to energy security, and the GCC is absolutely crucial there, and this is a sort of reflection of that. But at the same time, Tom, this also sort of shows that maybe the EU is not in the same position that it always has been historically, with maybe not the same sort of strong ties with the United States, and the GCC being such a key player on dealing with everything from the sort of instability within the Middle East, but again, that key energy security. So it really is striking when you see, Mohammed bin Salman walking through the rooms here with Ursula von der Leyen, really sort of explaining the kind of new world that we live in, one that is a little bit more fragmented, and one in which the sort of Middle East and the GCC leaders are really trying to play a central role in, particularly navigating the geopolitics.
Yeah, and as you say, that energy component is really interesting, isn't it? So from one conflict, Ollie, to another, because EU leaders, new EU leaders, of course, many of them newly appointed to their roles, not all of them, but many of them, meeting today with President Zelensky, who's going to be joining. What are we expecting then on Ukraine?
Yeah, so listen, Tom, this is, we should say, the first time that we've had an EU leaders summit since we had the sort of commissioners appointed for the new commission, and the first time since we had the Draghi report that really lays out kind of some of the priorities for the next 5 years for the EU. And Tom, we should also not lose sight of the fact that it's the last one before the U.S. election, and the U.S. election will be absolutely decisive on a number of different issues, but perhaps no issue more than Ukraine. And so what Zelensky is doing here in Brussels today is he's presenting before EU leaders his victory plan. We got the sort of early contours of that in front of Ukrainian parliament yesterday when Zelensky sort of laid it out, and some of the components that it includes. It includes obviously not relinquishing any territory to Russia. It also includes basically what he's looking for is an invitation into NATO. That is not membership, but that is showing sort of willingness to go there, and also to basically lift all restrictions on weapons to be able to strike within Russia, but also calling for more weapons to be delivered as deterrence for the future term in Ukraine. And he said non-nuclear. He hasn't said what those weapons are, but these are all going to be sort of the key topics, and it's be very interesting to see at what level the EU leaders are willing to get on board on, one, the question of them joining NATO and at what rate, and two, this key question of striking within Russia. But of course, Tom, there is a bit of a sort of fear here that nothing can really be decided until November the 5th when the U.S. election takes place.
Yeah, and you've got to wonder what the role of Viktor Orban of Hungary is going to be within these discussions. Ollie, when it comes to migration, the contention there, the splits within the EU, the tension that's been long running, of course, around this issue, where are the fault lines right now?
Yeah, so listen, Tom, and I think that's what is going to be really key in this discussion here is really getting to where the thought lines are, right? Because this is an issue that the EU can basically no longer ignore. At the national level, immigration is absolutely huge, whether it's in France, whether it's in the Netherlands or Germany, where I'm generally based. This is something that they can't ignore anymore, and it has seen a sort of softening of a lot of the tones from many of the politicians that are potentially, historically on the left, even Olaf Scholz. What I think is really interesting, when we spoke to Mette Frederiksen, the Prime Minister of Denmark, who is a social democrat, she says there's a real turning of the tide when it comes to immigration. Have a listen to what she told us in this exclusive interview.
It is changing a lot, finally. Thank you, dear colleagues. We should have changed the rules and the legislation in Europe a long time ago. It is actually because I am a social democrat that I'm quite tough on migration, and of course especially on irregular migration, because if too many people from outside Europe enters Europe, the problems with lack of integration will simply be too big and too massive.
So she's really seeing a changing in the conversation and really putting at the top of the agenda the question of immigration. Giorgia Meloni, the Prime Minister of Italy, will be chairing a meeting on this on the sidelines. By the way, Italy, for the very first time this week, has deported migrants to Albania in a sort of third country agreement. Could this be one of the models that the Europeans start to look at as we look going forward? And Tom, we should also mention this is not just an EU sort of illegal immigration question. This is also causing conflict and tension within the EU, where you have 8 countries that have effectively suspended Schengen and are doing border checks at their borders. So this is something that is very important for these European leaders to resolve.
OK, Oliver Crook on the ground for us in Brussels. An important update. Thank you very much indeed. Now, coming up, a feisty Kamala Harris gives her first interview to Fox News as a poll by the network shows Donald Trump pulling ahead. We have the details next. Coming up. Stay with us. This is Bloomberg.
I remember how right the market was on Ronald Reagan in 1980, despite what the pundits were saying. And I must say, in the last 12 days, the market and the inside of the market is very convinced Trump is going to win. You can see it in the bank stocks. You can see it in crypto.
OK, the inside of the market very convinced that Trump will win. That's the view, at least, from billionaire investor Stan Druckenmiller speaking exclusively to Bloomberg there. Meanwhile, Kamala Harris sat down for her first interview with Fox News as she seeks to broaden her appeal to conservative voters.
Let me be very clear. My presidency will not be a continuation of Joe Biden's presidency. And like every new president that comes into office, I will bring my life experiences, my professional experiences, and fresh and new ideas.
OK, let's bring in at this point opening trade anchor Kriti Gupta, always has a finger on the pulse of US politics. Kriti, this was a line that stood out because for me, this is the clearest I've heard Kamala Harris articulating at least what she hopes to frame as a break from Biden, if that's the way that we put it. How different will a Kamala Harris presidency be if she wins versus what we have with Biden?
Well, it's a little bit of a catch-22 because what we have with Biden is also what we have with Vice President Kamala Harris. So the idea that she's breaking away is crucial, but she's already kind of said that through many of her policy agendas. For example, her kind of position on Gaza, her position on what's going on in the Middle East is a marked change. It's far more vocal than that of her predecessor at the moment. It's also a key to point out that she's going even further on some of her economic policies in ways to address things like inflation, housing, et cetera. One of the key pillars of the Biden administration is things like drug pricing and creating controls on that. She goes a step forward and says we should expand that to housing, to groceries, et cetera, to make affordability in the United States a key issue. But then she takes a step back when it comes to things like corporate taxes, for example, a 28% line that Joe Biden wanted to push through Congress. She's saying about 26%. So you do see this push and pull, some divergence, but from the top lines compared to Donald Trump, of course, very, very similar. 25 minutes, a combative interview with the #1 network in the United States. Mixed reactions on how that's being interpreted.
OK, Kriti Gupta, thank you very much indeed with the analysis on that interview. Anchor, of course, of Opening Trade, covering US politics for us as we build up to, of course, that election, November the 6th in the US. Let's bring in at this point Lizzy Galbraith, political economist at Abrdn, for more analysis. Lizzy, thanks for standing by. You've very effectively broken down in your notes to us different potential outcomes in terms of the mix as to whether or not you get a Trump or a Harris and how the congressional mix breaks down in terms of the Senate and the House. Talk to us first of all about where the odds are on some of these combinations and then how we think about the policy that can come through that. But let's start with some of the different options that you've outlined.
Yeah, so overall, we see the odds in the race as essentially being 50-50, and then we break that into 5 different scenarios, 2 on the Harris side and then 3 on the Trump side. So for Harris, we see overall a 40% probability that we see a Harris victory, but with a constrained Harris. So in that she does not have Democrat control of Congress, and therefore she's limited in her ability to push forward the agenda that she's campaigning on at the moment. We see a pretty limited probability of her being able to secure what we're calling a blue wave, so full Democratic control of Congress as well as the presidency. We put those odds at only 10%. And then for Trump, our base case is what we're calling a Trump trade war 2.0 scenario, where Trump wins, but he does not have control of Congress. And therefore, we see a situation in which he's focused on policies that he can implement through executive order. And that leads him to focus on tariffs. It leads him to focus on some elements of his immigration policy. We see a 15% probability that we see a very market-friendly Trump that is focused on tax cuts and deregulation. That requires him to have full control of Congress. And then we also put a 10% probability on what we're calling a full fat Trump, in which you get a Trump with unified control of Congress that does implement these tax cuts and the deregulatory agenda, but is also fairly focused on implementing tariffs as well. So you get basically all of the different policy flavors of Trump at once. He implements essentially everything he's currently campaigning on rather than just elements of it. And really the sort of the takeaway that we're trying to present here is that Congress really matters when we're talking about what the actual impact of this election is going to be, particularly for Harris. It really does constrain the policy platform that she's putting forward at the moment. And the other factor that we're really trying to demonstrate here is that you can get very different outcomes, even if you're talking about a single candidate winning. There is still quite a lot of uncertainty as to what type of presidency we will be seeing over the next 4 years.
Yeah, do not lose sight of those Senate races this time round. Lizzy, on the trade front in particular, you talk about the policy response in terms of potential additional tariffs, risks of a trade war under a certain scenario with Trump. Just give us a little bit more detail on how that could come to pass and why you're putting that at around a 25% probability, which sounds, to some at least, unnervingly high.
So I think the thing to note in that scenario is that we're not saying that Trump will implement all of the tariffs that he's currently campaigning on. We do think he will be slightly more constrained than that, because in this scenario, he's working through executive orders. But because this is an area where in his first term he did implement tariffs through executive order while he was constrained by Congress, we think this could be a focus for him should he not benefit from being able to implement, for example, a large tax cutting agenda because it's blocked. So we think that certainly we would see measurable increases in Chinese tariffs, for example, but we don't think that 10% baseline tariff on the rest of global trade is something that he'd be able to implement without congressional approval and would be instead a bit more targeted.
Lizzy Galbraith, political economist at Abrdn, with some smart potential outcomes as a result of this US election. Thank you. There's lots more coming up. Stay with us. This is Bloomberg. Welcome back. Yes, it's an earnings day, but it's also a day-to-day, particularly in the US. You have industrial production, you have jobless claims out later, but also arguably the most important data print of the day out of the US is US retail sales. Expected, in fact, for the month of September, this is the expectation, the orange line, to tick up 0.3% from an increase of 0.1%, suggesting that maybe the consumer's holding up if that number comes through. But Bloomberg Economics says there is some seasonal effects at play, and also the cooling labour market means that consumers are constrained. That data will drop later today and we'll give you the analysis. There's lots more coming up. The opening trade is next. Stay with us. This is Bloomberg.